did you start?
Okay.
When did you start trading? Like, when did you decide to say, "Ish, I need to look into this"?
It started about say last year in March.
Last year in March.
Yeah.
That means you're over a year now,
Yeah.
right?
Yeah. But you see, I when I contacted the person,
Yeah.
he said to me, right, open this one. Okay, now you close that one, open that one, close that one. But
Oh,
I don't know how or what or why. I just followed what he said I must do.
okay. So, oh, like Llewellyn told me that you're using signals.
Yeah,
That's totally the wrong way to go about it. Yes,
yeah,
in some cases, for some people, it's gonna work. But if it's a
yeah,
case that you don't know what you're doing, then
yeah.
under
That
normal
that is it.
circumstances, it doesn't work.
Yeah.
Yeah. So basically, me, what I do is I teach you how to come to the decision to say, okay, I'm gonna buy this asset, I'm gonna buy this commodity, or I'm gonna sell Euro USD. That's what I'm gonna teach you. I'm gonna teach you to understand how the market works, how you can do your analysis on your own. Eventually, you have to be in a position to do that on your own so that you understand what you are doing.
Yeah.
Yeah,
That is what.
that's the most important thing, which everyone who joins the group, I need to make sure that they understand that part, to say, okay, Ivan is saying we are looking to buy Euro USD. Why is he saying that? What's the reasoning behind that? You see, that's what I
Okay.
aim to teach everyone who joins in. And I'm sure you've already seen that the group, there's quite a few guys now in the group who already know what they are doing.
Okay.
Yeah. So eventually, you're going to get there, but I'm not going to promise you that it's going to be in the next month or in the next 2 months, because it all
Okay.
depends on you. You see?
I I
Yeah.
fully understand that.
Yeah. It depends with you how you're going to catch up, how you're going to understand. I'm sure the basics now, you've got an idea of the basics.
Yeah. Yeah.
You've got an idea of the
Hello.
basics, right?
Yes. Yes, sir.
Yeah. So what we are going to do now, I'm just going to run you through just the basics. Uh, the most important things that I would say you might need to have, like a pen and paper that you're going to write down. And then once we are done, I'm going to send you this ebook that we are going to do now. If you don't prefer,
Okay.
yeah. But I always ask people to have a pen and paper, because when you write something, it's hardly that you forget it. You understand.
Yeah. That.
Yeah.
Yeah. I understand that. Okay.
Yeah. So I'm going to highlight the few most important things that you need to really know. Not just a case of understanding. You must know that, okay, when we are talking about this, what are we talking about? When we are saying the market is weak, what are we talking about?
Okay.
Yeah. So I'm sure you've already started with the course on Udemy. How
Yes.
far
Yes.
how far are you with that one?
I'm 27% there.
27%.
Yeah.
Okay, no, not a problem. You must take your time, and don't be scared to ask questions. You see?
Okay.
Because most people, they'll be like, I don't want to look daft, I don't want to look like a bum, like I don't know what I'm
Yeah.
doing.
Yeah.
You must ask. That's the only way you're
Yes.
gonna improve.
Okay.
Yeah.
Yes.
Don't be
Yes. I
scared.
will.
Yeah, don't be
Okay.
scared to ask. So in this online presentation, we're gonna talk about mainly the terminology and the worst mistakes that most traders do, which already
Okay.
you've done one of it using
Yeah.
signals.
Yes. Yes.
Yeah. So that's the main things that we are going to be talking about tonight, and I'm sure that will take us about an hour or so, if I'm not mistaken. So when you're getting into this industry, you need to understand one thing: the decision to make a trade, whether you're going to buy or sell, eventually it ends up on you as a person. You must know okay, am I going to buy gold or am I going to sell oil? Only you as a person. Why am I saying that? Because it gives you control of your equity. You need to be in control. Don't rely on someone's decision to control your equity. I can't come to you, Jerome, and then I'll say, Jerome, you must do this with your $5,000. That's not good.
Okay.
You should be able to make that decision on your own.
Own.
Yeah. Many people, they like to take the easier path, using signals or having someone trade for themselves. Yes, it might work, but under normal circumstances, that does not work. You see? So you yourself, you should be able to sit on your PC, say on Saturday or Sunday, you analyze the market. You come to a decision to say, okay, in the coming week, I'm going to be looking for these opportunities on this asset or on this currency pair or on this commodity based on your analysis. You see?
Okay, so can I just ask them something?
Yes,
If you sit on a Saturday or Sunday, isn't the market closed by the time or
great. When the market
how
is
does it work?
closed, you see,
Okay,
when the market is closed, there's two things that you are blocking out. Number one, you're blocking out all the noise that go on when you're looking at a live chart.
okay,
You're blocking that noise. You're working with static market, which is closed. Number two, the decisions that you're going to make, they're based on a forecast. You're literally forecasting that, okay, I've read so much. The fundamentals, the news that are coming out on channel 411, they're saying this and this about the rand. So I expect the rand to trade to a certain level before it drops or if it goes up. You see? Because
okay,
once you try to do that, yes, to some extent, but only once you know what you're doing. Personally, for me, I can make a decision instantly just by looking at a chart, whether it's a live market data or the market is closed. I can make a decision. But for most people, I advise them to look at their charts, have a trading plan that you do on a Sunday to say, okay, I'm looking at Euro USD, right? Already we know that the Euro is going to be under pressure, meaning it's going to get weak. So if you look at Euro USD, it means there's levels that you're going to be highlighting. On a Sunday, you mark those levels. Eventually, when that level gets reached, either on Monday, Tuesday, Wednesday, or Thursday, then you make a decision to trade, whether you're buying or you're selling. Not to say that come Monday or Tuesday, you wake up from nowhere straight to your 15-minute chart or 5-minute chart or 1-minute chart, which it is. Then you say, I know I'm going to buy this without concrete evidence. You see, without any evidence for you to say, why am I buying this? Why am I selling gold? You see, you need to have reasoning behind every trade that you make. If you see yourself trying to get into a trade without any concrete fundamentals behind it to say, okay, I'm going to sell this asset because of so and so and so. If you see yourself doing that, then that trade is not going to work. That is basically gambling. You're gambling with the market. So I always advise, if you have noticed, I always, I'm not, you have only noticed it once. You joined last week, right?
yeah,
Yeah.
Thursday.
Yeah. Every Sunday, I post the weekly forecast. You see?
Okay.
And I always do that on a Sunday. After I've digested everything that happened the previous week, after I've taken a look at what we call the COT report, you are going to learn about this eventually later on, like when we're doing institutional supply and demand. That's when you're going to learn about the COT report.
Okay.
Yeah, it helps in determining the directional bias where we expect the market to go in terms of higher time frame. Right.
Okay.
So those are the two main things. So obviously, you know what's Forex. Forex is a short for foreign exchange, which is a decentralized global market. Decentralized, it means no one really is in control of the market. That's why we have New York we've got London, and then we've got Hong Kong stock exchanges. You see, it's not a centralized market; it's decentralized. That's why it's very difficult to make money in a decentralized global market. That's why many people, they don't make money. They don't understand that part. So each trade that you take, by now I'm sure you know this, it involves two currencies, right? Because you're betting on the value of one currency against the other. For example, if you look at the most traded currency pair, which is Euro USD, right? The euro in this instance is the base currency. So the currency which is always to your left is what we call the base currency.
The base.
Yeah, the base currency.
Okay.
And then the currency that's to your right is what we call the quoted currency.
Okay.
Right? So if the price for Euro USD pair is $1.12, right? It means 1 euro is equivalent to $1.12.
Yeah.
You get my point there?
Yes.
Right. So if, for example, the number increases, say the $12 increases to $20, this means that the euro is getting stronger because you are getting more. Yeah, you are getting more dollars. But now, if that value drops from $12 to say $10, it means the euro is weak and the dollar is strong.
Okay.
Yeah. As the market is open 24 hours a day, 5 days a week, it has become extremely liquid over time. Extremely liquid, it means there's now too much money in the market, like over 5 trillion is traded every day. So trades can be closed over 5.
I did have a quick question.
Yeah.
It says the market is open 24 hours a day. But I remember now when we did one trade and I wanted to close it, it said market is closed.
Right. There is a period of switch. Like if I'm sure you wanted to close that trade probably between 11 p.m. and 12 midnight.
No, it was earlier than that. It was around 8, just past 8 to 9.
Do you remember what currency pair you were trading that you wanted to close?
That was now when I started. So I didn't read. That's why I say you just said to me, look for Euro USD. And you say open, make your lot size like 0.9 or something like that. We didn't have stop loss. We didn't have like take profit. No, you just said leave it like that. Okay, until tomorrow. So you see, I didn't know what I was doing. So that's why I asking how about the 24 hours. So
right. Yes, right. We're gonna get to that part when we reach the trading sessions part. I'm gonna explain this part to you because there's a point when the trading sessions overlap one another. Like you find a period when the New York session overlaps into London session. Or the London session overlaps into New York session, and then New York session overlap into the Asian session. You see, these sessions, these are the moment they overlap, normally there's like a 15-minute or 30-minute time frame when the market is closed, when they are switching from one session to another. But under normal circumstance, it's 24 hours. Obviously, you're going to get a time when it's midnight, when London session is closed, Asian session is opening at 1 a.m. That time from midnight to 12:30, yeah, it will be closed for like those 30 minutes. The market will be closed. So if you are in a trade and then you try to close that trade, it's not going to close. If you try to open a trade, it won't open a trade. It can only open pending orders. There's what we call pending orders. That's what it can only open, but not like market execution, instant trade. It won't open. Yeah, we're gonna get to that part shortly about the sessions. So number 2, already you have highlighted that you were just opening a trade without any stop loss or take profits.
Yeah.
Never do that. That is not right.
Okay.
Yeah, that is totally wrong, because yes, the trade can go in your direction and then you make money, but you must always look at the other side of the coin. What if it had gone against you? If you don't have a stop loss, then it means probably your equity, your account can get blown. You see?
Yeah, that's what happened to me.
You see, if you don't have a stop loss, your account is going to get blown. And always know this: brokers are not your friends. They're there to make money from you. So when they see you
Okay.
trading in that kind of a way, they'll be smiling because they know that they're going to catch you. You see?
Okay.
Yeah. So you must always make sure uh, when you place a trade, always make sure you have got your stop loss and your take profit.
Okay.
Yeah. So what is a commodity? A commodity is a raw material used in commerce. Commonly traded products are gold, oil, natural gas, silver, copper, and wheat. There's quite a lot of commodities, but mainly gold and oil. Those are the most liquid commodities that are traded. But for now, since you're starting, I don't advise you to trade these two, gold and oil. They're going to need you to have quite a huge equity
Okay.
in your account. Yes, there's a way you can get around that. It means by increasing your leverage. I'm sure you remember when you open an account, they ask you to choose your leverage size. That 1:500, 1:400, 1:. If you open your
I
account, did you open your own
I
account when you were trading?
I know the broker he helped me,
Which broker were you using?
but I just remember I never heard this about zero. What is it? 1 2?
1:500. That's the leverage.
Yeah. Yeah. I never heard about leverage. So.
You,
And yeah. Okay.
you've got a
I
lot
just
to
want
learn.
to
Okay. No
get started.
worries.
Yeah.
No
Okay.
worries. You get there. You get there.
Okay.
Yeah.
I
So
was with O Invest.
with what?
O Invest. O Invest.
No, I've never heard about those ones.
Okay.
Anyway, be that as it may, that's not
Yeah.
an issue for now. So we've got commodities and we've got currencies, and then we've got what we call indexes, right?
Okay.
An index is basically a measurement of combined, say, currencies or companies or assets. So you find out that we've got what we call the FTSE 100. I'm sure if you watch news, they're always talking about the FTSE 100, the Nikkei, the Shanghai Composite, the S&P 500. I'm sure you've heard of those on the news.
Yeah. 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 Yeah.
Yeah,
Yeah. Yeah.
those are what we call indexes. They're also quite
Okay.
expensive to trade. But if you get in at the correct time and come out at the correct time, you can be filthy rich with indexes, but they're very difficult to trade. There's also what we call the Nasdaq.
Okay.
Many
Yeah.
people, many people right now in South Africa, they're trading the Nasdaq, but many people are struggling. They are failing.
Okay.
Yeah. So indexes also, they're quite difficult to trade, but if you know how to follow, say, the earnings report of big companies and everything, then yeah, they can be lucrative. But me, I always advise people to first master what the currencies. The moment you master how to trade currencies, and then you apply that to the indexes, you apply that to the commodities, you apply that to any other CFD that you can that you can trade. You see?
Okay.
Yeah. So these are the basics of Forex. There's no central market, meaning it's decentralized. So Forex starts on Sunday. It starts with the Sydney session, and then we go to the Tokyo session. The Sydney and the Tokyo session, they are collectively known as the Asian session. This is the market that opens from 12:30 midnight up until 7 a.m. our local time. So
Okay.
12:30 to 7 a.m. That's the Asian session. It means the Asian market is open. You see, like right now, people in Sydney, Australia, to them it's almost like AM, mid towards early morning right now. So it means their markets are now about to open.
Yeah.
Then we've got London session, which normally starts at 9 a.m. up until 10 p.m. our time. Then we've got New York session. New York session and London session, they overlap. New York session starts at 3:30 in the afternoon up until 12 midnight. That's the New York session. So Forex timetable starts on Sunday from 10 p.m. GMT and finishes on Friday 10 p.m. GMT and does not actually close. Market is open for 24 hours. But those sessions, when they overlap, like you find out when it's 11 p.m., that's when Wall Street close. That's when Wall Street close, which is New York, up until 12, up until 12 midnight. That 1 hour in between, yes, the market is going to be open, but things like the spread, they're going to be very high. Things like the commission, they're going to be very high. The spread is the difference between the buy and the selling price. We're going to get to it, I think, in the 4th slide from here. Yeah. So session-wise, what you need to take from the session, always know that it's always good to trade the London and the New York session. The reason being that is where most of the money is traded. New York and London session, that's where most of the money is traded. The Asian session, yes, you can trade the Asian session, but you're going to find out that the market does not really move that much during the Asian session. It can move maybe like 10, 15 pips from like 1 a.m. up until like 4 a.m. The market does not move during that time. But the moment we get to 9 a.m., you're gonna see like the market moving very fast. Yeah.
9 hour time.
Yeah, this is our time. Yeah. Our time, GMT plus 2. 9 a.m., 10 a.m., you're gonna see that the market moves massively. That's when London opens. It means the big guys, the big institutions, they're placing their what? Their orders, because those are the only people who can move the market. As retail traders, we don't move the market. We are tiny drops in the big ocean. We don't move the Forex market. The Forex market is moved by the institutions. You see? The big guys. When we talk of institutions, we're talking of the JP Morgans, the Goldman Sachs. You see? Those big HSBC banks, those are the people who move the market. Retail traders, they don't move the market because we don't have the equity to do so. So here is a small, like a few terminologies that you really must understand. Number one, pips, right? Pips, this is the smallest movement in a price a currency can make. E.g., we've got Euro USD at $12, and then it moves to $15. It would have moved how many pips? I'm gonna explain to you.
Again, I lost it.
Don't worry. Okay, don't worry. We're gonna get there where I explain in detail. This one is just an introduction. I'm gonna explain. This is just an introduction. So number one, we've got pips, the smallest movement in price a currency can make. Then we've got balance and equity, right? Equity refers to the absolute value of a Forex trader's account. Say you've got $500 in your trading account. That's your equity. And if you place a trade and that trade has got a profit of say $150, right? Your absolute equity becomes $650. You see? If that trade is making you a loss of $100, your absolute equity becomes $400.
Okay.
You see? Then we've got bull and bear market, right? The term bull and bear market is used to describe how markets are doing in general. That is, whether they are appreciating or depreciating in value. An appreciating market, we call it a bull market. A market which is depreciating in value, we call it a bear market. You see, that's where bearish and bullish comes from. So a bull market, it means the market is appreciating. The value of an asset is going up. A bear market, it means the market is depreciating. It means the value of an asset is going down. It's getting weak. A good example, if you open your MT4 chart and look at gold. Gold in May, it was trading well below, I think, 1700 or 1800 in May. It was trading below 1700. But prior to end of June, start of July, end of July, start of August, gold traded to 2,000 an ounce. It means it appreciated in value. That's a bull market. So we call that gold has been in a bull market for the past 3 months. Because it has been appreciating in value. Then we've got lot sizes, most commonly known as lots. Remember those 0.9 that when you open a trade, you put, that's what we call a lot size, right? So a standard lot size is similar to trade size, meaning it's 1:1. If you open a standard lot size, it means your lot size is probably 1 or more. That's a standard lot size. Then we've got micro lot sizes. Micro lot sizes, they're in between 0.1 and 0.99. Those are micro lots. Then we've got mini lots. Mini lots, those are the ones from 0.01 up until 0.09. Those are mini lots. Then we've got bid and ask prices. The term bid and ask, also known as bid and offer, refers to a two-way price quotation that indicates the best price at which a security can be sold and bought at any given time. That's bid and ask. If you notice on your platform, there's always two prices on an asset. There's one for selling and there's one for buying. And those prices, they are different. The difference between those two price quotes is what we call the spread. The difference between the bid and the ask price. The difference between the sell and the buying price. The difference is what we call the spread. You're going to see it later on. And then we also have short and long positions, right? So if an investor has long positions, it means that investor has bought and owns the shares of a currency or a stock. It means he bought something that he expects price to what? To appreciate. When you are in a long position, you are expecting the price to appreciate in value. You are expecting a bull market. You are expecting a bullish movement of price, meaning price will be going higher. By contrast, if the investor has short positions, it means that the investor owes the stocks to someone but does not actually own them. If you are short on Euro USD, it means you are selling Euro USD, meaning you are anticipating Euro USD to depreciate in value. You are anticipating Euro USD to get weak. You are anticipating Euro USD to be bearish. Do you understand that part?
Okay, yes, sir.
Yeah. So if for instance I say, Jerome, we are going long on USD CAD, right? For instance, say we're going long on USD CAD, it means I'm expecting USD CAD to appreciate in value, so we are buying.
Yeah.
And if I say we're going short on NZD USD, it means I'm expecting New Zealand dollar against US dollar to depreciate in value, meaning bearish market.
Okay, sir.
right? And then we've got stop loss and take profit, right? Take profit orders are limit orders that are closed when a specified profit level is reached. Say you buy USD ZAR at 15 Rand 70, and then you say my take profit is 16. So the moment if you buy at 15.70 and then the price gets to 16, so 16 will be your take profit. If price reaches that, then your trade is going to close in profit.
Okay.
Conversely, if you buy at 15.70, you have to put a stop loss. So you put a stop loss below when you're buying. So 15.70,
Okay.
say your stop loss is 15.60. That means 10 pips in between. So if price trades to 15.60, that means your stop loss is going to be triggered. You'd have made a loss.
Okay.
See? You'd have made a loss, but your account is still preserved. If we didn't put a stop loss, right, and then the price keeps going down, it means we are going to have what we call margin calls. The broker is going to be sending you messages for margin calls to say you need to deposit more money, you need to deposit more money, because you're holding a losing position.
Yeah, that's what happened to me.
A lot has
Yeah.
happened. A lot has happened to you, bruh.
Yeah, he said to me, yeah, you must deposit more money, you must deposit more money. But I didn't understand why.
Yeah, these people, they misled you. They really misled you.
Okay.
Yeah, because for me right now, my the straight up thing that I'll tell you, don't deposit any money right now. First, focus on learning.
No,
Yeah,
I've stopped that. Yeah,
yeah,
I've stopped that.
because you always be losing. Then we've got what we
Okay.
call pending orders. A pending order is a request made by a trader to a broker to say at which price level a position should be opened or closed. This comes now to my Sunday's analysis, whereby you'd have done your analysis, right? And then you say, okay, USD ZAR is trading at 15.50. But if it comes down to 15, I want to buy USD ZAR. Because you'll be anticipating the dollar to appreciate in value if you're buying USD ZAR.
Okay.
You're anticipating the dollar to appreciate in value and the rand to lose value. So if you place a pending order, it means you'll be putting an order below the price, the current price, to say, okay, if rand gets to 15, open a buy position with a take profit, say at 15.50. You see? Eventually, I'm going to show you on the platform how to do all this. Right now, it's mostly theory. On Wednesday,
Okay.
we're going to the charts, because theory is the most important thing. I won't want to talk about something on the charts without you understanding it first.
Okay.
Yeah. Then we've got leverage. Leverage is the ability to trade with a large amount of money that you have in your total account margin. Say you've got $500, right? When you have $500 in your trading account, and then you want to open a standard lot size position on Euro USD, right? You can open that position, but your equity is going to take a huge hit, right? So what most people do is they increase the leverage. You deposit, say, $200, then you increase your leverage to 1:500. You can open a 2 lot size position with a $200 account.
Okay.
There's advantages and disadvantages to it. The advantage that it has is it gives you the opportunity to grow your account massively if the trade goes in your direction. Remember, a standard lot size, it means for every pip, it's $10.
Okay.
That's a standard lot size. So that means one. So for every pip that the currency pair moves, is $10 a pip. So it means if you are opening standard lots and then you open a standard lot size of 2, it means every pip is $20.
Okay.
You see? Now, what happens then if you have got a $200 account, then you open a position, say a buy position, but then the trade goes against you 10 pips. You see, the $200 is gone.
Okay.
You see, the $200 will be gone. So I always advise people to stick to small lot sizes. If you want to trade like standard lot sizes, first grow that account to say at least $2,000, $3,000 before you can start thinking of doing standard lot sizes. Because they can be good if the trade goes in your direction. But if the trade does not go in your direction, that account is going to get wiped out instantly.
Okay.
Yeah. So you must understand that part of lot sizes. You must always, if you have say $500, the maximum lot size that you have to open there probably is 0.1. You see, 0.1 meaning $1 for every pip. That way you preserve your equity. You're managing your risk. You don't want to get into a trade and then the following day that account is blown. No. You need to make sure you survive in the game. Make at least 10 trades. Out of those 10 trades, you make sure you win at least 4 or 5. With good risk management, at the end of the day, you make money. If you're following proper risk management. Say for every trade you're targeting 1:3. And then you make 10 trades, you only need to win 4 for you to make money. But I'm going to show you eventually how to do all those calculations. Now, margin is the deposit required to open or maintain a trade. A good example for gold, if you have $200 and you want to open a 0.1 lot size trade on gold, if you have $200, it means you're going to need your margin, your leverage to be high, maybe 1:1,000 or 1:500 for you to open a standard lot size. That's margin. You see? I'm sure you've seen it, like when you open a trade, instantly that trade is negative.
Yeah.
That negative amount that is deducted, that's part of the margin. The spread and margin. You see? The broker instantly takes money. They hold it in a different, say, account, because they require that money to hold the position that you are in. So that's margin. So if you keep losing now, if your trade keeps going against you, that's when they send you margin calls, like messages or emails, or they even phone you to say it's either you're going to close the trade or deposit more funds. That's when you get margin calls. Then we've got chart types. Reading and understanding a forex chart can be said to be a form of science. This is because they look complicated at first glance. Don't be intimidated by those candlesticks or anything. They're not that intimidating at all. But once you get used to it, it can be quite easy. It's very easy to read candlesticks. They're not that intimidating. Most people, they struggle, but it's not that difficult at all. Then we've got majors, minors, and exotics. These are the currency types. You see? For now, we're going to be focusing on currencies. So we've got 3 types of currency pairs. We've got the majors, we've got the minors, and then we've got the exotics. I'm going to explain those in detail. So now here is a bit of a detailed explanation of pips. So we've got pips. Some people like to call them points. In America, they call them ticks. See? So it's all about what you are more comfortable with, but pips is what is most people here refer them to. So this is $25934. This is probably GBP USD. $25934. Yeah, this is British pound against US dollar. So 4, the number 4, which is the first, this guy here, right? That guy represents 0.4 pips. You see? So that means if it moves to 5 here, to 35, it means the currency pair would have moved 0.1 pips. You get my point there? Jerome, can you hear me?
Okay.
You're breaking up a bit. Can you hear me?
Can you hear me?
Yes, I can hear you.
Yes, sir, I can hear you clearly.
Right, I'm gonna repeat again. I think we had a breaking network there.
Okay.
Yeah, your network is breaking up a bit. I'm not sure if you can hear me.
I can hear you, yeah. I can hear you clearly.
Okay, let me just repeat again what I was saying. So we are right now, I'm gonna explain in more detail what I've just talked about, like the intro I was giving you. So pips, some people they like to call them points, and in America they call them ticks. So this is $25934. This is GBP USD, right? The British pound against the US dollar, right? So the last digit to your right, which is 4, it represents
okay.
it represents 0.4 pips, right?
Oh,
So if this currency
okay.
pair moves to 25935, it means it has moved 0.1 pip,
Oh,
right?
okay.
Now the
Okay.
second one to your right, that one represents 3 pips. That means if the currency pair moves to 40 here, right? Say it's 5940. It means it has moved 6 pips. You see? It means the currency pair has moved 6 pips. If it moves,
Okay.
yeah, then the third number from your right,
Okay. Okay. Yeah. Okay. I see now. I see now. What you?
the third number from your right,
I didn't at first see it, but now I see it. You with 90 pips.
you can see it, right?
Yeah.
Yeah. So the 9 represents 90 pips. That means if this currency pair, let me just clear up this. If the currency pair moves to say 2, so this is 259. If it moves to 26000, the difference between the two, right? So
Okay.
here we've got, let's just do the maths. 10, we've got 6. So 10, then we've got 4. So this one is 10. So it would have moved 46 pips, right? If it moves from 25934 to 26000, it means this this pair has moved 46 pips. You understand that part, right?
Okay.
Yeah.
Yes. Yes. I see it now. Yeah.
Yeah. So under normal circumstances, it's very it will be under extreme market conditions that you see the number to your left after the decimal place. This number here, it either means one economy is crashed if that number changes, right? So the 5 represents
Yeah.
500 pips, and then the 2 represents 2000 pips. That means if this currency pair moves back to, let me just clear up. If the currency pair moves from 25934 and then it moves back to, say, let's say it moves to 3000. Let me clear up. It moves to 3000, right? To 1.3000. The difference between this number, right? The difference, which is, let me just do the maths quickly. So that's 1300 minus 125,934. So you're looking at 1.30. Sorry, 1.300 minus 125,934. It would have moved 400, close to 400 pips. The difference between these two, it would have moved almost like, yeah, close to 400 pips. Let's just do the maths. 10, so we've got 6 there, and then 10 we remove 4, we've got 6 there. So this one becomes 0, and then 10 minus 5, then you get 5. So it would have moved 506 pips if price goes to 1.3000. It means the asset would have moved 506 pips. Yes, market can move this amount of pips, especially during now when there's COVID, when there's too much uncertainty in the market. The market can move. You find out that gold, 2 weeks ago, it moved like almost close to 7,000 pips. You see?
Okay.
So the pips is where the money is, right? The pips and the lot size. That is what is gonna get you to make money. So for instance, let's say we've got 500 pips, right? We have 500 pips and we had opened a position of 0.1 lot size. 0.1 lot size, it means for every pip is equivalent to $1.
$1.
Every pip. This is a micro, this is a micro lot size, right?
Okay.
So for every pip is $1. So if the asset moves 500 pips, it means you have made what? $500. But now, if it's a standard lot size, right? If it's a standard lot size, it means for every pip it's $10. So 10 times 500, that's 5,000. You see?
Yeah.
That's $5,000 profit out of 500 pips. You see? But for you to open a position with a standard lot size, remember, you need to have more equity, right? You can open a standard lot size with say $500, but it means your leverage is gonna be high, right?
Yeah.
Your leverage is gonna be high. But now, what if those 500 pips are not reached? You've got $500, right? And you're going with $10 per pip standard lot size. It means for you to lose $100, this currency pair here, GBP USD, has to move only 10 pips. If it moves 10 pips, you've already lost $100 of your $500. You see, which is too much. You see, that is too much to lose because you've already lost like what? That's like 20% of your equity.
Okay.
That is not good. You should always aim to lose less than 5% of your equity. So a standard lot size on a $500 account is not advisable. Yes, you can trade a standard lot size, but you are risking too much. You see?
Okay.
Meaning you might not survive in the game because if that asset moves 20 pips, 20 times 10, that's $200. You have already lost 40% of your equity, meaning you've got less than $300 left in your trading account. That is not good. You see, you can't trade in that kind of way. Then balance and equity. The balance represents the outcome of a trader's closed position, be it a profit or a loss. That's the balance. The equity is what the traders would see in the balance if they were to close all their open position at the moment. So as long as an investor has ongoing trades, the balance does not represent the actual amount of your funds. Remember the balance. Even if they have a significant balance, they could have much less equity if their open positions are with substantial losses. So your balance can be blue, but if your trades are red, ultimately, when you close those trades, it means your balance is going to be red.
Okay.
Yeah. So, for example, if a trader is deposited $500 and open a position that's gotten them a loss of $100, they will see the balance of $500, but the equity will be $400. So, by eventually, when you close that loss of $100, then your equity becomes net 400, but your balance will still be on 500. It's good to understand these things so that you know eventually when you're looking at the chart. Then we've got the bull and the bear market. A bull market is when prices are rising or are expected to rise. Bull markets are associated with investors' expectation that strong results are to continue, meaning they are expecting the market to appreciate in value. When investors are pessimistic and expect prices to decline, it is referred to as a bear market. You see? You are expecting the price to go lower. You see? Meaning you're expecting bearish prices. You're expecting to be selling. And then we've got lot sizes. When investors purchase and sell financial instruments, they generally do so in batches rather than a single instances. These batches are called lots, right? That's lot size. The lot size differs depending on the market and the security you are trading. The common sizes for currency pairs, for example, are 100,000 for a standard lot size, 10,000 for a mini lot size, 1,000 for a micro lot sizes. But the sizes could very well differ even for two instruments of the same market. Gold could sell by two lots of 2 units each, while silver lot would consist of say 100 units. So it depends with the asset that you are trading. You find out that you might have say $500, but you can't open say a 5 lot size on a certain asset. You see? So it depends with the asset that you are trading. That's why I always say, no, you must stick to say, when you're still learning, stick to the micro and the mini lot sizes. Standard lot sizes can mess you up big time, but if you do make money, that's when you see people trying to say Forex is easy, Forex is this. No, Forex is not that easy. People must know that Forex is very difficult. Then we've got bid and ask, right? The price, can you hear me, Jerome?
You can hear you, sir.
Yeah. Now we've got bid and ask. This one is very important. I want you to pay a bit of attention here. The price at which a security is sold for is called bid price, also known as the selling price.
Okay.
Ask price is how much one can buy a security for, right? That's the ask price. It is often called as the buying price. Sometimes the bid and the ask price are equal, but usually there's a small difference called the spread, right? We've got what we call the spread. The spread goes to the market maker as compensation for the risk. The spread is what I normally call the cost of doing business with the broker. The broker is going to charge you. You see? So, for instance, we've got this price here, $69.58, and then we've got 69.64 at the bottom. You can see the 69.58 is in red, meaning it's your selling price. The 69.64 is in green, meaning it's your buying price. The difference between these two price codes is 0.066 cents, right? 6 cents is what we refer to as the spread. Yeah, that's the cost of doing business. For a liquid instrument, for example, is like Euro USD. It means an instrument which is traded most oftenly by many people. Euro USD, USD JPY, USD CAD. You see those major pairs. They're most traded. We call them liquid instruments. It is easy for the market maker to turn around and buy and sell to someone else. So the spread is very small. You find out that the spread on Euro USD is very small. But you look at USD ZAR, the spread is very high. Yeah, because USD ZAR is not that liquid. There's not many people who are going to be trading USD ZAR. So you must always know that it's best to stick to major pairs because they are not that expensive to trade. Remember, the spread is the cost of doing business. So when you're doing your risk management, before you open a trade, say on Euro USD, you have to take note, what's the spread? You see, if the spread is 10 pips, right, and you want to open a 0.1 lot size, it means the moment you're opening that trade, you're already losing $10 from the spread.
Oh, okay.
Yeah. So you need to first make up the $10 before you start making profit, because already the broker has charged you 10 pip spread, right? And if you open a position with $0.1 a pip equals $10 on 10 pip spread. So you need to, that trade has to make you at least 15 pips for you to make money. So it means you have made the 10 pip for the spread and 5 pip for your profit.
Oh, okay.
You understand that part, right?
Yes.
Yeah. We're going to talk about those when we are in the risk management section later on, I think 4 or 5 lessons from now. Then we've got short and long positions, right? A long position is when price is appreciating. And then short position is when price is going to the downside. When a trader buys a security expecting the price to rise, it's called a long position. When I say, Jerome, let's go long on USD CAD, it means we are buying. We're going long. See? And then when we want to sell a security, right, it means we are shorting, we're taking a short position. It means we're expecting the asset to go to the downside. So if we think that the value of euro against US dollar will fall, we are going to short euro USD. If we think the value of euro against US dollar will rise, we're going to go long on euro USD. Then we've got stop loss and take profit. A stop loss order closes a position if a security reaches a certain price. This certain price is what you as a trader define. If you enter a position and then you say, no, I need 50 pips stop loss. So if the currency pair or the commodity moves against you those 50 pips, then that position is going to close, meaning your account is not going to get blown because you would have calculated your risk. You see, essentially, stop loss is stops losses from mounting up if the price goes in an unfavorable direction. That means if the trade goes against you, a stop loss is there to guide your equity so that you don't keep losing. However, even if a position is in profit, an investor might not want to risk the price turning the other way so they can take profit. So for instance, you're in a trade and then it's blue making money. You can close the trade or you can wait for the price to reach for your take profit order. You specify this when you're opening the trade. You specify your lot size, you specify your stop loss, you specify your take profit. Yeah, this is part of the risk management now, because forex is not that difficult, but it's not. It doesn't mean it's rocket science. No, it is hard, but it's not rocket science. We all know rocket science is very tough. There's not many astronauts because rocket science is very difficult, but forex is not at that level. So eventually, if you do master your risk management, there's no way you can fail. If you find yourself just opening trades randomly without calculating your risk, you are opening trades randomly with different lot sizes, different stop losses, different take profit positions. If you find yourself doing that kind of trading, you are not going to survive. You'll always be donating money in the market. Your account will always be blown. Then we've got what we call pending orders. There are 4 types of pending orders, right? These ones, they've got also, this part of the lesson has got a practical session on MT4 or MT5, where I'll be showing you how to place these orders. So there are 4 types of pending orders. Number 1, we've got the buy stops. A buy stop is selected when a trader anticipates the current uptrend, meaning the bullish move, the bull market. If you expect the bull market to continue, you place what we call a buy stop. So the entry point is placed above the current price. Say USD is at 1550 and you expect it to keep going high and high and high and high, probably up until 16 or 17. So you place like buy stop at 1560 or 1570. That is a buy stop. Then we've got what we call a sell stop. Sell stop is the opposite of a buy stop, right? It means you are expecting a bearish market to continue going to the downside. So if USD is at 1550 and you expect it to go all the way to 15 or all the way to 14, you can place sell stops below 1550, say maybe at 1520, at 15 or at 1490. You place your sell stop because you're expecting the market to keep going to the downside. You see, that's a sell stop. Then we've got a buy limit. A buy limit, this is when the market is currently declining, right? It means the market is bearish. But during that bearish move, you as a trader, you are expecting now the market to bounce, to go to the upside, right? So this is when you place your what? A buy limit order below the current price. So for instance, say we've got market USD is 1550. Maybe we've got a supply zone or a support area, a support area here, right? And then you as a trader, you'd have noted that, okay, USD is now at an oversold position, meaning it has gone way too down, and you're now expecting the market to go to the upside. So you can place a buy limit, say at 1500, right? You're expecting price not to go lower than 1500. That's a buy limit order, right? That's a buy limit order. You're expecting a bounce in the market to the upside. Then we have the fourth one, which is the sell limit. This is when you anticipate the uptrend to reverse into a downtrend. Say the market has been going high, and then it's now at the extremes, which is a resistance area. You see, so it's an area where you expect price to find resistance and turn to go to the downside. So you place your sell limit here, then market goes to the downside. So that's a sell limit. The reason why we use orders, it's not like every time we are always going to be on the charts. Remember, we have other things to do, right? We've got work commitments, we've got family commitments. We can't always be on the charts. So we make use of pending orders because we are not always going to be on the chart. You can't sit on the chart from 7 a.m. up until 11 p.m. No, that's not healthy. You see, some people they do that, but you can't do that like your whole life. You see, so you make use of pending orders. Say you look at an asset, Euro USD, and then you see in the morning, no, Euro USD is now trading at $18. Yet you are expecting Euro USD to go all the way to $20. It means you place a buy stop above $18. You place a buy stop, then you forget about it. You see, if you are anticipating the market to come down when it's trading at $18, then you place a sell limit. You see, maybe $19, you place a sell limit because you're not expecting the market to keep going all the way to $20. You place a sell limit order. You're practically saying, okay, if Euro USD gets to $19, open a sell position. You see, open a short position for me. You define your stop loss. The stop loss probably you put it at $20. Then your take profit, you put it maybe at $17. That's a hypothetical example, but you understand what I'm saying. You see,
Yes, yes.
Yeah. So that's the main use of pending orders,
Any
because
order.
we can't always be, even you know yourself that probably maybe during this time I won't be able to get to the charts. You see, then you make use of pending orders, because you don't want to come later on when you open the chart and then be like, oh, I miss a trade, I should have done this. You see, so that's where
Yes.
you get to make use of pending
Pending order.
pending orders. So I'm going to show you this on the practical side when we're doing the platform, how you place pending orders. Then we've got leverage and margin, right? Leverage and margin. Since fluctuation in price changes are small most of the time, a retail trader will not benefit much by investing solely their own money, right? If there was no leverage, most retail traders, we were not going to make money. So brokers, they provide a way to open positions for larger amounts, right? For larger amounts, it means standard lot size. We are able to open standard lot sizes than what our normal equity accept. So that is what is called leverage. So with $500, you find that you can open, say, a 2 lot size position, right? With a leverage of 1:500. But if you put a leverage of, say, 1:1, you can't open that 2 lot size position on a $500 account. That's impossible. It's not going to happen. You'll be opening positions of 0.01, 0.02 if leverage is 1:1. But if leverage is 1:500, 1:700, whichever highest leverage that the broker provides, then you are able to trade bigger lot sizes. So, for example, if an investor has deposited $100, right, and the broker provides leverage with a ratio of 200:1, which is 1:200, the investor can open a position of for as much as 20,000. So that $100 that you have deposited, you can have imaginary funds of up to 20,000. You see, meaning you can open even a 5 standard lot size. You see, because the broker has borrowed you 19,900. You see, they are very clever.
Okay. Now say if you lose now that trade, then what's gonna happen?
Right. If you lose the trade now, right? Let me properly give you a good example. You've got $100, right?
Yeah.
And the broker provides you a leverage with a ratio of 200:1 or 1:200.
Okay.
The investor can open a position for as much as 20,000. You see,
Yeah.
you see what happened here? We've multiplied our equity by 200, right? Which gives us 20,000. So if you open, say, a standard lot size position of 1, right, on, say, Euro USD, and then Euro USD, right, you open a standard lot size of 1, meaning $10 per what? Per pip. Remember, standard lot size, $10 per pip, right? If Euro USD, let's say you buy, if Euro USD moves 20 pips to the upside, you'd have made 20 times 10, which is $200, right?
Okay.
Meaning your equity now is plus 200, which is equal to 300, right? That's
Yeah.
now your equity. But now, this would have been a good trade. It means you bought and Euro USD moved 20 pips to your direction. But now,
Okay.
if the trade moves against you, say 5 pips, right? You buy, you have bought Euro USD, but now the trade has hit your stop loss. Your stop loss will be, say, 5 pips. So 5 times 10, which is equal to $50, right?
Okay.
The $50 is gonna get subtracted from your $100, meaning you now have $50 remaining in your account. You don't have 19,000 remaining in your account.
Okay.
You see?
Okay, I thought now maybe because of that you're gonna owe them the 19,000.
No. You're not gonna owe them the 19,000.
Okay,
That's not how it
okay,
works. Yeah,
okay,
they will just be bugging you. They'll be phoning you to say you need to deposit more money. You see?
okay,
Yeah. If for instance this position moves 10 pips against you, it means your $100 is blown. Your account is what?
okay.
Your account is blown.
Zero.
Yeah.
Okay.
You see, you're not gonna be owing them 19,000. No, that's not how it works.
Well, okay.
Yeah. So that's why it's very important that you have your stop loss defined and your take profit defined. Then we've got chart types. There are several charts a trader can use for analysis. I'll show you the most popular ones, and to make things simpler, all the examples will use the same trading session. That is going to be the London session. So we've got a line chart. A line chart is a single line connecting all the closing prices. It doesn't offer much detail, but a line chart is good for observing long-term trends and picking out patterns such as head and shoulders and triangles. Then we've got a bar chart. A bar chart shows the closing prices, the opening prices, the highs and the lows of a security. Then we've got the candlestick chart, which is the most popular. Almost everyone uses a candlestick chart. Candlestick charts show the same information as bar chart, except for each candlestick having an enlarged region between the opening and the closing price. Candlesticks is something like that. You know already this. You see, that's
Okay.
our candlestick. Then we've got a point and a figure chart. A point and a figure chart is a series of x's and zeros. Each x represents an increase in the price and zero shows a decline. Whenever the market reverses, a new column is drawn. That's why a trader never sees X and O in the same column. This chart is mostly used for long-term trends like the line chart. But for MT4, MT4 does not provide us with the point and figure chart. It provides us these three: the line chart, the bar chart, and the candlestick chart. Those are the ones that are provided by the MT4 platform or MT5 platform. Then we've got the currency types. We're almost done. We've got 6 slides to go. Don't worry.
Okay.
Yeah. Now we've got the currency pairs. We've got the majors, we've got the minors, and we've got the exotics. The major currency pairs consist of most frequently traded currency pairs globally. Because they have massive liquidity, you are able to trade them virtually always. You see? Furthermore, you find that the lowest spreads or brokerage cost of doing business when trading these pairs is very low. Trading these major pairs only for intraday trading. Intraday trading, it means you're opening a position, say today, and then tomorrow, if you have got a small account, then tomorrow you're looking to exit that position. If you've got bigger account, that's when you hold a position for quite a long time. So here's a few examples of major pairs. Number one, we've got the Euro USD. You see, Euro USD, that's the Euro dollar. This is the most traded currency pair out there. You see? So it's also commonly known as fiber. So you might find in some cases when we are speaking, I'll refer to, we need to look at fiber. You see? So you should know that fiber is Euro USD. Then we've got British pound against USD, also commonly known as cable or the sterling. You see, that's British pound against USD. Then we've got dollar yen USD JPY. This is the US dollar against the Japanese yen, one of the most traded currency pairs also. Then we've got the USD CHF. That's the dollar against the Swissy. So commonly known as Swissy, Swiss franc. If you take note, every currency pair that's here have got USD either as a quote currency or as a base currency. You see here on USD CHF, USD is our base currency And then CHF is our court currency,
Okay.
right? Then if you look at GBP USD, British pound is our base currency, and USD is our court currency.
Okay.
Same applies on Euro USD. On USD JPY, it same applies on USD CHF. USD is our base currency, and USD JPY is our court
Good.
currency, meaning we are trading the US dollar against the Japanese yen. On GBP USD, we are trading the British pound against the US dollar. So these are some of the examples of major pairs. We also have USD CAD. It's a major pair. USD against the Canadian dollar. Yeah, that's a major pair. Then we've got minor pairs. Minor pairs, when a currency pair doesn't include the US dollar, it's called a minor currency pair or a cross currency pair. When there's no US dollar, most commonly in that pair, we call it a minor currency. Here's a few examples. New Zealand dollar against the Japanese yen, that's a minor currency pair. Euro against the Australian dollar, it's an example of a minor pair. The British pound against the Canadian dollar is an example of a minor pair. Same applies with Euro against the British pound. The main difference between the minor pairs and the major pairs, number one, the USD, when you're talking of minor pairs, the US dollar is not in the equation. On the major pairs, the USD is on every pair.
Yeah.
Number two, the spreads. The major pairs, the previously mentioned, the Euro USD, USD CAD, USD JPY, their spreads are very low. You find out that Euro USD can reach as high as, say, 12 pips, as low as 2 pips. Then when you come to, say, Euro GBP, you find that it can get as high as 45, 50 pips of spread. Then it can go as low as maybe 21 pips, 20 pips. You see, meaning the minor pairs, they are also a bit expensive to trade. Meaning you're gonna have to reduce your risk. How do you reduce your risk? By using a small lot size. You see. Then we've got exotic pairs. Right. An exotic pair includes a major currency and the currency of a developing economy. Remember the BRICS, the emerging markets, such as Brazil or South Africa, Argentina, Mexico, Turkey. You see the currency pairs of those countries against, say, the dollar, or against, say, the Japanese yen, or against, say, the British pound. That's what we call an exotic pair. You won't find exotic pairs as often as you find major and minor pairs. Reason being that they are very thin on liquid. There's not many people who trade exotic currency pairs, so they're not that liquid, meaning they become very expensive to trade because their spreads can be very high. You see? So here's a few examples of exotic pairs. We've got the Japanese yen against the Norwegian krone. We've got the US dollar against the Hong Kong dollar. We've got the euro against the lira, Turkish lira. We've got the commonly US dollar against the South African rand, USD ZAR. These are some examples of exotic pairs. Yeah, I wouldn't really advise to trade this because yes, they can move, but their spreads are very high. Like on USD ZAR, at one point it can reach as high as 300, 400 pips. So it won't be ideal to open, say, even a 0.1 position. You see, it's not ideal because it means you need to first make up 300 pips before you can see profits
Profit.
coming. Yeah. So
Okay.
exotic pairs, they're not really ideal markets to trade. Then we've got this small chart here, volume by currency pairs as of 2019. The most liquid currency pairs, you can see the Euro USD has got 20%, USD JPY 13%. Australian dollar against USD is also a commonly traded pair. USD CAD is also commonly traded. AUD USD is mostly commonly traded because of gold. Remember, Australia exports a lot of gold. Their economy is mainly based on gold. That's why you see AUD USD is also most traded. USD CAD is also commonly traded. Reason being that Canada is the largest exporter of oil to the United States. So we can practically say the Canadian economy is mostly dependent on what's happening with the United States. That's now fundamentals. You see how these things join up. So if you see the American economy struggling, you have to expect the Canadian economy to also struggle. If US imports a lot of oil from Canada, then you expect the Canadian economy to appreciate, meaning you have to understand that the Canadian dollar is going to appreciate in value. Then you've got British pounds making up, say, almost close to 7.3%. Then you've got the rest: NZUSD, GBP, JPY, Euro JPY. So these are some of the assets that you have to look to trade. You see, not all of them. You see, always have a portfolio of currency pairs that you say, I'm going to stick to these pairs and try to master how they move and everything. Everything has got a footprint. There's always tendencies that a currency pair move, but it takes time for you to really understand. Like if you ask me Euro USD, how does Euro USD move? By just looking at the chart, I can tell you that by the time we get to $20, we are going to find some resistance. And it's not going to break that price point quite easily. So it takes time. I'm not saying you should trade all the currency pairs. You open any chart, you trade, open any chart. No, no, no. You must always have a portfolio of, say, maybe 3-4 currency pairs that you trade. So for instance, if I'm buying Euro USD, automatically I'm not going to buy USD JPY. You see? Because it means one of my trade is going to lose.
Okay.
You see? Euro USD, if you're buying Euro USD, it means USD JPY has to go down. Can you see? In Euro USD, USD is the core currency. In USD JPY, USD is the base currency. You can't buy them at the same time. It means one trade is going to lose. So if you're buying Euro USD, you must look to sell USD JPY.
Okay.
Yeah, you can't be buying both of them at the same time. That's not advisable because one of them is gonna lose. So yeah, so what are some of the mistakes that most traders make? Number one, most people, they trade emotionally. Most people are fearful when they have a winning trade. They think if they do not close it today, the trade is going to turn around and, and,
Yeah,
they,
yeah.
and they lose. So
Yeah.
you don't need to be emotional when you're getting into the market. That's why I advise people to always deposit the funds that are not important to them. Money that you can afford to say, no, I can afford to lose 500 rands. Let me deposit this and try to make more out of it. If I lose, then I lose. If I make something,
Okay.
then it's an advantage. You see, never deposit
Okay.
funds that you can't afford to lose. You can't go deposit 10,000 when you know that your mortgage hasn't been paid. You see,
Oh,
that's not
okay, okay.
that's not proper. Averaging down. You see, that's the second mistake that most traders do. Averaging down means increasing the size of a losing position, right? Let's say you are in a trade, and then that trade is losing. Then you see that it's getting closer to your stop loss. Then you move your stop loss again so that the price cannot reach. When price is reaching your stop, you move it again. Eventually, you're going to lose more.
Okay.
You see, that's averaging down. It's not advised. If you enter a trade, leave the stop loss. If price reaches your stop loss, accept that and move on. You see, then you analyze. You see, okay, I was wrong there. You analyze, what did I do wrong, so that you don't do the same mistake next time. You see, so averaging down is another mistake. Trading without risk control. Some people who enter trades without any risk management strategy, that's like randomly just opening position. You open a 0.1 lot size position, you open a 1 lot size position, you open a 0.5 lot size position, you put 20 pips stop loss on one trade, you put 40 pips stop loss on the other. That's not risk management. You're not going to succeed in this industry if you don't manage your risk properly. If you open a position and you say, okay, every time I enter a position, I should have a 20 pip stop loss, targeting what? 60 pips. So your stop loss will be 20 pips, but your take profit is going to be 60 pips. That means your risk is 1:3, right?
Okay.
Okay, let me just explain this nicely. So 20 pips stop loss, and then you have a take profit of 60 pips. So this now equates to 1:3. So that means for every pip, you're targeting 3 more pips. You see?
Okay.
So if you maintain this ratio, this risk management, right? Out of 10 trades, right? If you win 4 trades, right? So that's 4 times 60, right? And then you'd have lost 6 trades. That's 6 times 20.
20.
You see? Let me write that correctly. So 4 times 60, so that's 6004. So that's
240.
240, right? So you got 240 pips profit. 6 times 20, that's
120.
120. You see, risk management, what it does. So out of 10 trades, you can only win 4 trades with a risk management of 1:3. You only need 4 trades out of 10 to make, what's the difference here? 0 to 1. To make 120 pips. You see? That means if you have $100, right? If you have $100, right? Then you say at the end of the week, say end of the week or end of the month, you have taken 10 trades. And out of those 10 trades, you have won 4, right? If you have won 4 with a standard lot size of 1, no, let's use a mini lot, 0.1, right? Meaning every pip is $1. So out of 4 trades, you'd have made $240. Then you'd have lost $120 that you'd have lost. So the difference, 240, 120. So you'd have made 120 profit, right? Meaning at the end of the week or end of the month, your equity is now 220. You see, that's what risk management is all about. But if you open random position, say you've got a 0.1, a 0.5, 20 pips stop loss, 40 pips stop loss, this is not going to work. You see? So this is very important that you manage your risk. You understand, okay, if I'm going into a position, what's going to be my risk management strategy that I'm going to use? 1:3 or 1:2 or 1:4. So if your stop loss is 20 pips, if you're targeting 1:5, that means your target has to be 100 pips. You see?
Okay.
Yeah. So out of 10 trades, you only need to win 4 to make money. You do this 2 times. You do this 2 times, maybe 20 trades. It means you're going to win 8 trades. 8 times 60. 8 times 60 is going to become 480, right?
Okay.
So you'd have won 8 trades out of 20. Then you'd have lost 12, right? You lost 12. 12 times 20. Remember, if you lose a trade, it means you're losing 20 pips, meaning you'd have lost 240. 480 minus 240, you have made 240 profit. 100 plus your 100 in your equity account. That means by the end of 20 trades, you have 340.
Yeah.
You see, so it's a gradual process. You are gradually increasing your what? Your equity, irrespective that you have lost, say, 6 trades, you have lost 12 trades. With your risk management, irrespective of those losses, your account is growing. You see? That's what most people they don't understand that part. You see? They want to get into trades, make $500, make $1,000. No, that is not gonna work. That is not gonna work at all. And then number 4, not following a plan. Most people who are starting their trading career or anything, they often don't have any plan before opening a position. By plan, what do I mean? I mean by having an analysis that you are following. You've got a currency pair that you are monitoring. You've got a commodity pair that you are monitoring. You analyze that currency pair before you enter a trade. I'm sure you've already seen some of the videos that I've posted on my YouTube channel and everything, where I break down the market structure of an asset from a monthly all the way to a H4 time frame, where I'll be making a decision to say, okay, no, if price reaches at that price point, then we are looking to buy or we are looking to sell. Yeah. So you must always have a plan. So yeah, I think that's it for today. And then we are going to meet again on Wednesday, 9 p.m. If you are available, you just have to let me know.
Okay.
Yeah. So that we continue. So this was the theory part of it. And on Wednesday, we are going to move further now to the platform where I'm going to show you exactly how to customize your platform, whether it's MT4 or MT5, of which I'm going to recommend you use MT5. MT4 is a bit shady on price movements and the spreads are not good. So I'll be showing you everything that has to do with the platform, how you can place your pending orders, how you can place your sell limit, buy limit, how you can do your analysis, how you use all those tools on the platform. So that's what we are going to be talking about in the next class. So this was just the theory to introduce you to like the terms and everything. Yeah. Yeah. So I have recorded this session. I'm going to upload it and I'll send you the link so that you can always have a reference point. Say you've got something that you need to look back on. So I'm going to upload it and I'll send you the link.
Okay, sir.
Yeah. I don't know if you have any questions.
Not at the moment.
Yeah. Don't worry, my brother. I'm going to help you as much as I can. And eventually you get there.
Yeah. With the right risk management, I will get there.
Yeah, the risk management part of trading is the most important, you see.
Yeah.
Because you can
I see.
Yeah, you can have a good strategy, but if your risk management is not good, you always be blowing your accounts. But if you have a proper risk management, then eventually,
because the
yeah,
way you explained it to me now, that is what I didn't understand. So
Yeah,
Yeah.
yeah. Most people, they don't
I have a
understand
good
that part. To say yes, you can lose more trades, but at the end of the day, you can make money. Most people, they don't understand that part. They just need to make sure if they enter a trade, they make money. They enter a trade, they make money. No, it doesn't work like that. You see, because in this
Yeah.
market, eventually you're gonna lose some money. So you need to anticipate that part of losing money in the forex market. But make sure when you lose, you're not losing and then you're out of the equation. No, you lose, but you stay in the game.
Yeah.
Yeah. Anyway, I think
Okay.
that's much for today. Then I'll see you again on Wednesday.
9 p.m.
Yeah. I don't know if you have time on Wednesday. I've got a class. I've got a class. I don't know if you have the time from 11:30 to 1 p.m. I've got a class at my office, Step by Spaces Century Waterfront. I mean, so if you have time, if you don't have, no worries. We can always have the class online. That's not an issue.
Okay.
Yeah.
I'm working at the moment, so
Oh, okay.
that's why
Not
I'm
a
doing it
problem.
online.
Not a problem, bro. Bit by bit, bit by bit.
Yeah.
Yeah, there's no rush in Africa. Bit by bit, you get there.
Okay.
Yeah. All right, my brother. Thank you.
Okay. Thank you very much, sir.
All right, my
Have a
brother. Keep
have a
well.
pleasant evening. Okay.
Okay.
You too.
Okay. Cheers.
Bye.
Bye bye.